Welcome everyone. My name is Tim Jackson. I'm delighted to welcome you all to this CUSP CES seminar, which, as many of you know in the room, is part of our Ecological Economics module. So this, for those of you who are on that Ecological Economics module, is a very natural continuation of the fascinating discussions that we were having this morning with Peter Michaelis and with Sian Ferguson from the Sainsbury's Families Trust, thinking about what on earth sustainable investment can mean, where it can go wrong, where it can go right. And I'm delighted to give you another perspective on that same issue from our speaker today, Duncan Austin. Welcome, Duncan. It's great to have you here. Duncan's worked for almost 3 decades in environmental economics and sustainable finance. He's worked for academic institutions, non-profits and profits. He's got a lot of experience. And from 2004 to 2018, Duncan was a partner at Generation Investment Management, which is a sustainable investment firm chaired by Vice-President Al Gore. So he comes with some credentials, I guess. And the interesting thing about Duncan, and this is kind of where he came into my, at least into my office actually. He walked one day into my office and said, I want to talk to you about my concerns. And the point about Duncan really is that a few years ago, he'll tell you a little bit more about it himself, he walked away from Generation because of the way that he felt sustainable investment was and was not addressing the core issues. And that's what he's going to talk to you about today. So it's a real deep questioning at the heart of sustainable finance, at the heart of all those things we were talking about this morning on the module. And Duncan's theme then is whether sustainability is the market opportunity, for example, that Lion Trust was developing its offering around, or whether in fact it has to be seen as a moral obligation. Duncan.
Super. Thank you very much, Tim, for that kind introduction and the invitation to be here today. And thank you as well for letting me walk into your office 3 or 4 years ago. I have been aware of Tim's work for a long time, and slowly but surely what Tim and other ecological economists were saying shifted a few brain cells to the point that I'm now able to make a presentation like this one. So the presentation is definitely quite challenging, and what I want to explore is this idea of whether the win-win sustainability strategy, by which I mean the idea that we can become sustainable if only we can find enough projects that are good for planet and profit together, whether that idea has itself reached some sort of limits, and if so, what do we do? I've got quite a few slides. I go pretty quickly through the middle, and I can leave a copy here if I don't get to all of them, which may be the case. Tim's introduced my background. The only thing I might add is that when you look at a problem for 28 odd years from 3 different perspectives, you slowly internalize the different perspectives that well-meaning people have on an issue, and why it is that they may have the same concern but still be talking past each other, which I think is one of the things that is a feature of the sustainability debate today. Just to pick up on the Generation comment, I had a wonderful time there. It was a great experience. The business did well. But as Tim indicated, in about 2018, I started to get a feeling that the win-win narrative, of which Generation is just one small manifestation, was itself slightly troubling, and I wanted to give myself the space to explore the issues which have become this presentation. So there's actually 4 sections. The first section just tees up some ideas. The second and third sections are really the main substantive points I want to make, and then the fourth we can expand or contract to wrap up depending on time. So the first section, I want to talk about this idea that I've come to think of as green wish with an I, and that's essentially ask the question, what if this win-win sustainability thinking is not achieving enough change fast enough, yet because it's so appealing we keep pursuing it to the detriment of other things that we may be able to do as well. So the difficult question it asks is maybe we're succumbing to wishful thinking. And to do that, I'm going to take a bit of a run-up. You'll know some of this, but just help us frame it. This is the rise of the term sustainability in the English language as measured by Google Ngram. Google Ngram isn't the perfect tool of analysis, but for distinct words like sustainability, it can be very informative. And the point is that sustainability is everywhere now, but it's not a word that I was taught at school. So it's one generation old, which is interesting because humans are social animals and we've always been immersed in nature. And within the blink of an eye, we've come up with this new term to try and capture some sense of our relationship with each other and with the environment. This has triggered a lot of concepts. One that's relevant for today's discussion is the idea of corporate social responsibility. Technical term, so it's used less, the axis on the right. But when I pull this up, you can see that it traces almost parallel line with a lag sustainability. So sustainability sort of triggered something in the private sector. And in fact, you can add another one, ESG, this idea of environmental, social and governance. It's an acronym, so there were uses of ESG beforehand, but you can see clearly from 2004 that it follows again. So sustainability has sort of, with a lag, triggered some sort of corporate and financial response. And in fact, if I go the right way, you can see that there are a whole load of terms of the same nature which are reflections of the business and investment world trying to reach out, take the message of sustainability and incorporate that into what they're doing. Socially responsible investing was a bit early, but in the main, you can see that they all bend up from the late 90s, early 2000s, 20 years ago, roughly. And you can come up with even more terms. Not all of these do well on Google searches because they mean various things. And these are, if you like, a full set of some of the private sector language around sustainability. The reason I want to introduce that is because I want to suggest it's all one thing. So that is all one meta strategy that we've been pursuing. And the last thing the sustainability world really needs is yet another acronym. I understand that. But sometimes I may refer to this as VML, for voluntary market-led initiatives to be sustainable. And VML sort of makes itself known with some familiar slogans: win-win, good for profit and planet, shared value, etc., etc. Lots of different variations. And there's definitely interesting discussions to be had about these tactics, if you will. So divestment and engagement are opposing tactics for how to deal with companies like fossil fuel companies. But in the main, these things are unified because what they're effectively saying is we're going to try anything but costly regulation. And I won't push a 4-letter acronym, that might be too much, but ABCR. That's what all of these strategies are agreed upon. But it wasn't always so. There's a lot of history here which I won't go through, but generally the big picture is that when environmental problems first came to serious recognition in the 50s and 60s, the term that really jumped up was environmental policy. There was an immediate instinct to see these as public goods problems for which policy was an appropriate response. And that continued up until about, well, it turns out exactly 1997. Take that with a grain of salt. These are just word counts. Which happened to be the year of the Kyoto Protocol, for which there were very high hopes, but ultimately it was a failure. And in that period, what you see is the downturn of environmental policy is a term that people were talking about, and the uptick of corporate social responsibility. And to my mind, this graph captures a major change that happened in 25 years ago, where the leadership on sustainability issues was passed from the public sector to the private sector. A lot of underlying reasons why that was the case, but let me just leave it there. Essentially, this is the strategy we've been pursuing. How's it going? You'll be familiar with this. Unfortunately, CO2 emissions are nearly 50% higher than in 2000. You'll be familiar with all the great acceleration trajectories. These are some of them. What I find slightly disturbing is that the ones from industry consultants, they still feel happy to sort of plot business as usual into the future. And so I think there's a dissonance emerging where there's a lot of enthusiasm and sincere effort going into solutions of a VML nature, and yet the trajectories mean we're still writing headlines like this. Headlines from the recent IPCC and COP events. And slowly and surely, it became clear to me that lots of people in the private sector were also noticing this. So these are headlines from mainstream business press or business journals like the Harvard Business Review. And they're all from articles in the last 2 or 3 years which started to question the win-win narrative, not whether it can make money, which it actually has done a pretty good job on, but whether it could actually live up to its sustainability hopes and claims. And some of the headlines are pretty hard-hitting. Corporate sustainability, that was meant to be a good thing, and now it's being seen as complicit. Win-win, the dangerous allure of win-win strategies. Okay, and so when I left Generation and wanted my own space, I felt a need to try and express it in my own way, and what sort of bubbled up was this idea of green wish with an I. So green wash is, everybody knows, it's overt, cynical instances where companies are pretending to do something on sustainability, but they're not really. But I started to become more concerned that the bigger risk is green wish, where lots of sincere, well-meaning people are trying to drive sustainability forward, but it's not adding up to enough, which is obviously very difficult to internalize and accept. So the second section, I want to sort of reground ourselves in the physical basis of ecological challenges. I'll focus on ecology. Similar could be done for social, which I'll indicate, but the main focus here is on the ecological ones. This will be familiar to you. It is rising global temperature approaching tipping points. From about 1.5 degrees Celsius, they go up even higher, but these are just some of the early tipping points that climate scientists have identified. One of the things that I think is not as well understood as it might be is that scientists' sense of where those tipping points lie has slowly been coming down over the years. That's just pure scientific research fact. This is a little bit confusing, but it essentially shows the different big reports that the IPCC have done over the years. And in 2001, remember that period when we were all confident that markets could solve it, there was a sense that large-scale discontinuities, tipping point type events, might only kick in at 3-4 degrees Celsius above pre-industrial levels. Okay? As the science has unfolded over the next 21 years, every time they do a report, it seems as though those tipping points are closer. And that's not because of anything we've done yet, that's just a sense of scientists coming to understand all the feedback process in the biophysical system. There's just some of the text that substantiates it. The key point is higher risks at lower temperatures than first thought. Why are they concerned about tipping points? 2 reasons. When you go through them, they may be irreversible. So if you lose an ice sheet, you can imagine it's going to take a very long time for that to reform. But they also, as you go through one, you accelerate the heating to get to the second, to get to the third. So there's the slightly ominous phrase ecologists use of tipping cascade, which is when a system goes through a sequence of tipping points. This is why people like Johan Rockström at the Stockholm Resilience Centre sort of takes to Twitter in despair. He says, I get tired that 1.5 is being treated as a goal or a target with all the wiggle room that might suggest, compared to a limit, which as a scientist is what he thinks of it of. I'll use climate as an example just to flag biodiversity. We thought of as a limit problem. We tend to think of bending the curve up above minimum species or ecosystem levels. A particular example is the Amazon. Unfortunately, compared to 1970, forest coverage in the Amazon is about 80% of what it was. The concern is that there's a tipping point in the 70 to 80% region. So this is bad enough, but if you got through a tipping point, it might accelerate downwards. This will be familiar to you. It's the planetary boundaries, but if you think about it, it's just a very clever way of showing 9 systems having tipping points. They just put it all in one circle, but it's the same concept. And I haven't got it here, but you can think about social issues also having tipping points. The difference being that biophysical tipping points allow you to draw pretty accurate straight lines. So ice will reliably melt at 0 degrees or as you go through 0. Where does a society start to break down? What measure of inequality? Well, that starts to, there's some level, but it's harder to draw as a non-fuzzy line. But let me stick with climate as an example. This is the graph I showed you earlier, just scrunched up. And I want to do a small axis change here. The first one is the obvious way to think about it with time and temperature rising. Just changed the x-axis there to be economic growth. Same vertical axis. And they look pretty similar for the simple reason that economic growth has grown pretty steadily over time. But the reason I want to do that, he says, is because this graph is now a version of this curve here, the environmental Kuznets curve, which plots, I'm sure you know, a measure of economic growth against a measure of environmental damage. And the first part of that curve is relatively uncontroversial. Most people sort of recognize that early stages of economic growth create some sort of environmental damage. The question is what happens next? And I'm going to suggest that there are 2 broad worldviews held by different groups of people and not always held explicitly. And one view is the economic view, because this is actually how it is taught in economics. And what this says is that, yes, early stages of economic growth may increase damage, but keep going because this curve will reliably come down again and the damage will reduce. And the reasons offered for that are that you will slowly develop the wealth, technology, just the appetite to clean up the environment. And so it's a good news story. Markets, growth will eventually solve environmental problems. And definitely it does happen sometimes. I mean, just to think of London, 1950s, smog-ridden. London's now a much more wealthy city than it was, and the air has new problems, but it doesn't have smog. Okay. But there's also another view, which I'll call the ecological view or systems view, and it's the intuition that people who have either studied biological natural systems or work with natural systems, it's the intuition they have. That yes, sometimes this does happen, so it's not one or the other, but the ecologist systems thinker will also say this sometimes happens. That a complex system becomes more complex, it crosses a red line, and then it can't get back. And the forward growth slows and it may even reverse. This happens to ecosystems, fortunately it happens to human bodies. It doesn't happen all the time. This is a story where systems heal themselves. This is a story where systems have gone past a point where they can heal themselves. So just to put that more clearly, same 2 graphs, I've showed this quite often now, and I've come to think it's one of the key core dynamics of the sustainability debate, because people often have an implicit bias towards one or other of these worldviews, but it may not be because they've thought about it. It may just have bubbled up because it's been part of their cultural background, it's come from their life experience, maybe the choice of profession leads you to think one way, techno-optimist way, or a farmer might be, well, yeah, sometimes things fail. And I think underlying a lot of the sustainability debates is really this. And for this group, this is the economics view. Essentially what ecological economics opens people's eyes to is the possibility of this as well. Now, something like that is it's a pretty consequential difference. So ideally, when you have theories that are competing, what you would like to do is run experiments, get the evidence and say, well, which is it? Is it the good news curve or the more challenging curve? So theory and evidence. And it turns out, since the EKC was first hypothesized in the 1990s, it took a bit of time to get going, but now there's been an explosion in research work into the EKC. These are hundreds of studies per year. These are the citations that have now accumulated. A lot actually from developing countries for the obvious reason that they want to know what their environment is going to be like because they're going through some of the more challenging parts of the development curve. And these studies look at everything from urban air pollution, sort of a fairly localized, quick problem, to global climate change, which is obviously global and slow moving. So there's a mix of different issues they're looking at. The problem is the evidence for the EKC isn't very good. So the meta-studies that have been done the past few years, now that they review the hundreds of individual studies that have been done, 52% of studies support the hypothesis, 45% support the hypothesis. Absence of consensus. No consensus exists. Most EU countries, the EKC model fails to explain the relationship between economic growth and environmental damage. It's easier to show it like this because what you find in some of these meta-analyses is a diagram like this one on the right, and it sort of says this is the theory, but what researchers are finding is that the EKC curve can take one of 6 different shapes. Okay? And I don't think the next person was trying to be funny, but his diagram was this. Okay, space saving, I guess. But essentially it was like, well, there's the theory, I'm finding 6 curves. One of which, by the way, is that. So that does show up. But obviously there are others, and some of them go up. So economic growth, as it comes out of the survey period, is damage is getting worse as growth goes up. Now I said it might bend backwards. None of these have that. So even though they've got some going up, they haven't got that. So what would the story of something like that be? It would be a society that grew, became more complex, and then crossed some sort of ecological threshold beyond which it couldn't get back. And the first consequence was that the rate of its complexity advance, if you will, would slow down, and then some possibility that it goes into reverse. Okay. Unfortunately, that is a story that has happened in human history. And the problem is that when it has happened, it tends to be a long time ago, and they're not data sets so much as ruins to study. It's the preserve not really of economics, but of historians and archaeologists. So one of the things that economics is sort of unwittingly doing as a very quantitative discipline is that it is privileging quantitative information over qualitative information. Okay, so it's closing itself off from some patterns of human history. And modern science doesn't always like to hear this, but you are actually allowed to learn from patterns as well as numbers. That's why humans tell stories. Okay, stories, particularly the ones that last for a long time, are essentially the transmission of patterns as something that might stick in your memory and be a helpful guide in some way for the future. And unfortunately, one of the patterns that is out there has been that this has happened to complex societies. Now, it doesn't mean that it's fated to happen. We're all here, after all, but we need to be aware of it as a possibility in a way that that curve from the economists immediately precludes, or it sort of rules out by assumption. Turns out that the researchers who study this sort of thing, they're sort of sucked in to try and put numbers to it. The numbers aren't very good. So this is for Easter Island. One researcher sent me this, and he said, well, I've tried to make a model about how that society became more complex, which he called wealth, but the environmental damage. Another researcher, there was sporadic population data, and he plotted it against palm tree cover, which they can get through, I guess, soil analysis. Numbers aren't great, but the point is the shape of the curve that they are gravitating to is completely different. So I've put a lot of lines up. Let me just summarize. So the economist sort of says growth is the solution. The evidence is weak. This line seems to be missing a threshold, which is what the climate scientists and biodiversity specialists are saying is sort of important. And then the people who happen to look at those instances where there have been collapses end up plotting a very different shape. Okay? I said it's important to keep trying to get evidence. The one thing, slightly sobering note, is that for something like climate change, we are the experiment. And it's becoming clear that there's nowhere to stand that's kind of safely outside of the experiment. All right? This is why precautionary principle was coined in the 80s, 90s as scientists started to think through these issues. And the idea was to pick up that there's this profound asymmetry of the evidence base, that we know what it's like to grow, we've got all that history, but we are growing into an unknown, and if you can't get out of the experiment, perhaps proceed carefully. What's interesting is the use of that phrase has declined. So as it shot up, but around the early 2000s, it declined. Section 3, I'll go through, and I may skip through section 4. This is our graph again, temperature increases. What I want to talk about is how economics and finance masks that. So in a market society, we increasingly make decisions about how to transform the matter and energy of the world depending on or using financial statements. And projects that pencil out to a profit get a green light and they go ahead, and businesses that keep making a loss, they collapse and they no longer influence the world. So this, if you like, is the dashboard that we're using to make decisions. We've interleaved a decision-making framework between ourselves and the natural world. Okay, this is what it looks like in real life. You can take it to extremes. And it's not too much of a stretch to say that the people who sit at desks like this, even though they don't think they're doing it, they are in some respects pulling the strings for the whole global economy. Because decisions they make here direct the capital that changes the world's ecology. Now, we've known about this for a long time. The deficiency of these are clear, which is why there have been so many attempts to come up with supplementary indicators of environmental data. This is one. Possibly it hasn't worked. So this had an influence on me several years ago. John Elkington, he coined the phrase triple bottom line in the early 90s. very sincerely behind that concept that business could juggle these things. And in 2018, he wrote an article in the Harvard Business Review. Essentially, I'm doing a product recall of that idea because I don't think it's worked. CEOs, etc., move heaven and earth to ensure they hit their profit targets. The same is very rarely true of their people and planet targets. Don't need to worry about the details of this. I was looking one day for diagrams on systems thinking. This came up, and what struck me was the highlights. So the researcher said, well, these are the variables I'm currently considering. Which look interesting. It's about how to teach systems thinking. But these are the variables I'm not considering, which look like they might be relevant. And I was struck by how clear that was and transparent. And what it made me think of is that these are the financial statements that we're using. Generally accepted is a sort of term of art in the financial world, that the accounting principles meet certain standards. But not in those financial statements are a whole load of things that are not being fully costed. And so when you look at these statements for long enough, as I did, at some point the thought comes to you, it's like, what does net income or profit, what does that mean if not everything is being costed in there? Particularly if, when it's positive, that thing will go ahead, and if it's negative, that thing will not happen. Okay? My friend drawn a cartoon. This is the dilemma that finance directors are now facing. Generally, the finance directors in the corporate world are the trustworthy ones. You end up being a CFO or a finance director because you can be trusted with the numbers. But they're having to sign off on generally accepted financial statements that are not fully costed, because a lot of these costs are not making it onto the piece of paper. And this is creating dissonance in people who think about it. Unfortunately, our current crop of CFOs were not trained to think about these issues. Just to tie this together, come back to these, you can tell a story where if the externalities are small relative to market decisions, then the market should be able to give you quite a good steer, and you should be able to get this good news story. Okay? Markets will respond if they've got the right incentives. If, scenario B, the financial metrics are only a smaller part of what's really going on, and in fact the externalities are large, you run the risk of this being the case because you're steering with a dashboard that doesn't reflect reality. Okay, so which is it? A lot of details here. The punchline, this is a World Bank review of how much of the world's carbon is adequately priced. 3.76 of carbon emissions are priced at the level that they need to be. So I think, just to wrap up this section, what's happened is the following. For various historical reasons, the world moved towards becoming more and more market-driven. And there are lots of good reasons why this is a useful tool. But we've discovered on our generation's watch, really, a lot of externalities. And so if you like market systems, I'm not anti-market, there are lots of attractive features to markets. But what you have to do to be a good steward of a market system is you have to internalize the externalities that become known on your watch. You can do that various ways, taxes, prohibitions, bans, but the key thing is that these things have to be not free in a way that they are now. Okay, just to give you a metaphor for that, Adam Smith spoke about the invisible hand, and there are lots of desirable attributes about the invisible hand, how it sets allocative and innovative dynamics. But what we're realizing is that the invisible hand has always had an unmentionable foot attached to it, creating ecological and social costs, and those are now looping back into our awareness. Final section, So I'll just do in about 5 minutes. What does that add up to? So again, to use climate, but I'm aware I'm using climate, but think of this as for other problems. Can it wait 5? Is that right? Yep. I'll come to you first. So to avoid going through tipping points, as you probably know, we need to drive emissions down pretty quickly. And it starts to have, metaphorically, the structure of a kind of turning the ship before you hit the rocks dynamic. You can think of this big heavy ship as being the global economy. Growth is its forward momentum. And somewhere out here are these rocky shore, unprecedented, that we don't quite know where it is or quite how bad it is. I'm going to suggest there's 3 basic maneuvers we can try and execute. The first one we have been doing, and this is sort of this VML idea, that markets, we think, well, they're dynamic. What we can do is we can get people in markets, consumers, investors, corporations, to care about this. And there's a certain amount of green innovation that will be triggered, and it will start to turn the boat. Okay? And some of it has. There's no question that there's, I think we're in a better place today than we were 20 years ago because there's been green innovations, green business plans, etc. The question is how much? And it's the concern that it's not enough that is really bubbling to the surface. So what can you do? Well, you can try and tighten the turning circle. You can get the government involved, and one of the things governments can do is they can subsidize green projects, tax credits, incentives, grants, etc., etc. So recent headline example is the Inflation Reduction Act in the US had the effect of directing a lot more fiscal stimulus to green projects. So that's good. You can tighten the turning circle. Okay? There's another direction you can go. This is why the boat is an example. Is sometimes you can go backwards in a boat. And that might be harder, but the judgment call is how close the rocks are and how fast you're moving. And so the other thing that governments can do, besides the carrots of incentives, is they can use stick-like policies that environmental and ecological economists have been talking about for almost 5 decades now, that will have a significant effect on turning that boat, but with the foreseeable consequence that it will interrupt, at least interrupt, the growth that we've become organized around. But it is a possibility that we've ruled out. And then if you go backwards, you might proceed. Long term's interesting. You might decide that you want to, inverted commas, grow as a society in a very different way. You might think of prosperity or progress as being something that has become detached from the sort of material-based growth that we have today. But this is difficult. There's no question. And only governments can do it because the private sector can only go forward. Okay, Amazon doesn't do backwards. Amazon can respond to government signals that say slow down, but only government can do it as an expression of collective will to say, maybe there's some things we should not be doing. Okay? And going from 1, which we've been trying, this VML strategy, to 3 requires a certain amount of moral movement to say, well, this is something we could do, it just may cost something. So to conclude, there are just a couple of details there. Sorry, 2 slides. This is very important. The idea of who might be able to go backwards is obviously or the capacity to go backwards is very unevenly distributed around the world. So this is wonderful Oxfam graph from several years ago showing the small minority at the top are responsible for a majority of emissions. You can flip it around and say, this is a graph of who has the capacity to really make a change. And so to sum up, what we'd hoped 20 years ago with that change of leadership is that sustainability might yield to a sense of it's a big market opportunity. And I don't want to say that there haven't been good things that have happened during that period. There have. The question is whether it's enough. And if it's not enough, then maybe the two steps that we need to focus on are accepting the difficulty of it not being enough. And then if it's not a market opportunity, it may well be a moral challenge. Moral's a difficult word. It's the word we reach for when something's possible, but it might be more effortful and costly than we would like. And actually, if we do those things, in the long run, you may then end up with authentic market opportunities, but we need to get the market signals right for this to be true. So thank you for your attention.